Where were you on May 6, 2010? If you're watching the markets, you saw something Wall Street has never seen before. In just 36 minutes, nearly $1 trillion in market value vanished, then almost magically reappeared. This is the story of the flash crash, the fastest, wildest, and most mysterious plunge in Wall Street history. It started as a regular Thursday. The Dow was already down like 300 points, rattled by the Greek debt crisis and global uncertainty. But at 2:32 p.m., the market suddenly went into freefall. In 5 minutes, the Dow plunged nearly 1,000 points, which was about 9%. Blue chip stocks like Procter Gamble and Accenture traded for pennies. For a moment, it looked like the entire market was collapsing. So what caused it? At first, some blamed a fat finger, a trader who accidentally sold billions in stock with a typo. But that theory didn't really hold up. The real story was a perfect storm. First, a massive mutual fund, Waddell & Reed, tried to hedge its portfolio by selling 75,000 E-mini S&P future contracts worth over $4 billion. They used the algorithm that dumped these contracts in an already jittery market with no regard for price or timing. That huge, relentless sell order overwhelmed the market's buyers, especially since volatility was already high and liquidity was thin. Then, high-frequency trading algorithms designed to profit from tiny price movements started selling too. They were trying to get out before everyone else got out. Instead of cushioning the fall, their lightning-fast trades made it worse. Liquidity evaporated. Prices spiraled. Within minutes, chaos ruled. But check this out, there was actually another twist. Years later, regulators charged a British day named Navinder Singh Sarol in market manipulation. From his parents' house in London, Sarol used a technique called spoofing, placing huge fake sell orders, then canceling them to trick the market and profit from the panic. Sarol didn't cause the crash alone, but his spoofing made the loss of liquidity even worse, accelerating the price collapse. So who was to blame? Waddell & Reed's algorithm started the avalanche. Sarol's spoofing kicked a few more dominoes. But the real culprit was a market system so fragmented and automated that a few actors could spark a $1 trillion meltdown. By 3:07 p.m., just 20 minutes after the plunge, the market had regained most of those losses, but damage was already done. Confidence was shattered, and nearly $1 trillion in value had blinked in and out of existence. Investigations found no single villain. Instead, it was a perfect storm of automated trading, fragile market structure, and human panic. The flash crash forced regulators to rethink the rules. Spoofing and layering are now illegal. Circuit breakers, automatic pauses were added to slow down future crashes. But here's the scary part. Flash crashes haven't really gone away. They still happen, sometimes in seconds whenever algorithms and panic collide. The 2010 flash crash was a warning. When machines run the market, things can break faster than anyone can fix them.